Ever wondered how you can use time as your ally in the world of Forex trading? Well, the secret lies in the power of compound interest. As an investor, this phenomenal tool can turn time into your most valuable asset. The beauty of compound interest lies in its ability to grow your wealth exponentially. Imagine, if you could double your initial investment of $1,000 10 times in a row, on the 10th time, you'd be a millionaire. Sounds thrilling, right? But remember, this is a strategy that demands patience and a long-term perspective. Moreover, it's not without its risks. Reinvesting your gains could multiply your profits, but it could also mean losing everything in a blink. So, it's crucial to take calculated risks. In the realm of investments, compound interest can be a potent tool, but remember, with great power comes great responsibility. To fully grasp the power of compound interest, you need to understand the Rule of 72. Essentially, this rule is a quick, easy way to determine how long it will take for your investment to double, given a fixed annual rate of interest. It's a simple division equation. You divide the number 72 by the interest rate you're earning. Let's illustrate this with an example. Suppose you've made an investment that's earning an annual interest rate of 6%. To find out how many years it will take for your investment to double, you would divide 72 by 6. The answer, 12, is the number of years it will take for your money to double at that interest rate. Now, the Rule of 72 isn't perfect. It gives you an approximation. But it's a handy tool that can help you make informed decisions about your investments. With the Rule of 72, you can easily estimate the time it will take to double your investment, giving you a clearer vision of your financial future. Now, you might be wondering, how does compound interest work in Forex trading? Forex trading with compound interest isn't just about multiplying your profits. It's a strategic chess game, where even the most minor moves can lead to significant outcomes. The concept is simple. You reinvest your profits, thus increasing your position size. The potential profits could be enormous, making the allure of compound interest quite enticing. However, the higher the reward, the greater the risk. This is where Forex trading takes a sharp turn from traditional savings accounts. In Forex trading, your capital is always at risk. You could potentially multiply your profits, but you could also lose your entire investment. Remember, anything that can grow exponentially can also explode. The explosion here refers to a rapid rate of growth, but it could also mean sudden catastrophic losses. That's why it's crucial to manage your money wisely. Proper money management techniques can help you control some of the risks associated with compounding your profits in Forex trading. One key rule is to never trade more than what you can afford to lose. This means setting a limit on the amount of money you are willing to risk in each trade, and sticking to it, no matter what. Another technique is to diversify your trades. Don't put all your eggs in one basket. Spread your risk across different currency pairs or markets. This can potentially help you mitigate losses in case one of your trades goes south. Finally, always keep an eye on the market. The Forex market is highly volatile and can change rapidly. Keep yourself informed about market trends and economic events that could impact currency values. Forex trading with compound interest can be a high-risk, high-reward venture. It's crucial to understand the risks and manage your money wisely. Remember, compound interest can be a powerful tool in the hands of a savvy investor, but it requires patience, discipline, and a solid understanding of the Forex market. So, is compounding your profits the right strategy for you? As we delve into this question, it's crucial to remember that investing is not a one-size-fits-all proposition. Every investor is unique, with individual financial goals and risk tolerance. Compound interest might be the secret path to wealth for some, but it's not for everyone. It's a long-term strategy that requires patience and discipline. The allure of rapidly multiplying profits is tempting, but remember, anything that can grow exponentially can also explode. This explosion isn't just about fast multiplication or a quick rate of growth. It signifies the potential for sudden, significant losses. Before choosing to apply a compound interest strategy, thoroughly consider your financial goals, your ability to withstand potential losses, and your patience to wait for your investment to grow. Understand the risks inherent to this technique and ensure you're not risking more than you can afford to lose. Whether you choose to compound your profits or not, the key is to understand the strategy and its implications fully. It's your money, your investment, and ultimately your choice.